Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. There are 3 things this week. First up, bond market boredom. What are we getting in Treasury bonds these days? Are we just clipping coupons and getting a little recession protection? Number 2, corporate earnings. Bank of America. It's not the biggest bank. It's certainly not the best bank, but it tells us a lot about the U.S. consumer and the American economy. Number 3, the Philly Fed Manufacturing Index. Potential future price pressures were revealed in this report. So back to number 1, the U.S. bond market. We reiterate our neutral rating on U.S. Treasury bonds, a table-pounding neutral rating. 10-year yields have been range-bound between 3.75 and 5% for the last 2 years, and they're smack in the middle of that range today at 4.42. We think this trend is likely to continue. Inflation's stuck around 3%. The Fed hasn't been able to cut. There's a lot of supply. But bond volatility is approaching the lows of the last 2 years. So complacency reigns in the bond market just like it does in the stock market. And we are wary of complacency for bonds, stocks, and the US dollar for that matter, as we head into the historically dangerous period of August and September when financial accidents, have tended to happen. Like we said, inflation has settled into the 3% zone for the intermediate and maybe even longer term. The CPI and PPI reports of this week confirm that trend in our opinion. Treasury term premiums are still rising because we have too much supply, we're running massive deficits, and the Japanese bond market continues to sell off on higher inflation. All of those argue for a continued rise in term premiums. So treasuries are likely to return coupons and not much more in the future. So why do we bother having these in our portfolios? At 440, that doesn't seem very exciting. And it's not very exciting. But we need to own treasury bonds in some percentage, and probably a shrinking percentage over time, but we need to own them for income, for the portfolio ballast that they provide during down equity markets, and for recession protection. If we have a recession, and someday we will, there are very few assets that go up when that happens, and treasury bonds will decline in yields and go up in price in a recessionary environment. And then there's deflation protection. It's inconceivable to think about deflation today, really, but we know at some point in the future it may rear its ugly head again. So we would stay in the 2 to 5 part of the curve. We see no reason to extend maturities. Why take on that risk? Term premiums likely to rise in the future. We know the budget deficits are intractable and we're politically incapable of dealing with them. That argues for higher term premiums. And we know that the gradual loss of Fed independence is a long-term risk for bonds. And we just had this point hammered home to us all week this week with the president and Republicans continuing to hammer away at the Fed and Fed Chairman Jerome Powell. Now on to number 2, Bank of America. A pretty good bank proxy. There were so many financial services reports that we had to decide on one, so we decided on BAC. What we learned is that net interest income is still growing by 6 to 7% year over year. That's pretty solid. So benefiting from a steeper curve, and net charge-offs are expected to remain stable. The consumer is okay. That's a really important message. There's a lot of controversy about that, but Bank of America says the consumer is solid, and we tend to agree with them. I always like to listen to managements about their artificial intelligence investments. And management said a lot that they think that these investments are beginning to yield strong benefits and greater payoffs are ahead. In their operations activities, they're getting cost savings. Programming, computer programming, costs are down 10 to 15%. wealth management, all kinds of things. AI is saving money in this area of wealth management. Commercial loan growth was strong. Every segment was up, both year over year and quarter over quarter, netting out at about 10% growth. That's pretty solid. That's a long way from recessionary conditions. Bank of America sees solid consumer spending, improving credit quality, and rising consumer net worth. They see no recession in the next 12 months. They're projecting 1.5% GDP growth. And interestingly, they expect no Fed rate cuts until the first quarter of 2026. So they have confidence they're returning capital to shareholders. They reduced shares outstanding by 4% year over year. They increased the dividend 8% this quarter. That's a significant increase, and you don't do that without confidence. Nevertheless, Bank of America's stock declined on the earnings report. Expectations are very high this quarter for U.S. financial services companies, and they're reporting good numbers across the board, but the stocks really aren't rallying. That doesn't trouble me. The stocks have done really well in recent months and weeks, and it's no surprise that they sell off a little bit. But the fundamentals are solid. And Bank of America, interestingly, I went back and looked. The stock price is the same today as it was in July of 2021. There's been no capital gain for Bank of America shareholders in 4 years. Brian Moynihan has been the CEO for 15 and a half years. That's a very long time to run one of the major banks. So the bottom line is, when banks are doing well, equities normally do well. And it just underscores that we are in an equity bull market here in the United States and globally. Now, finally, the Philly Fed Manufacturing Index. The Philly Fed Index jumped to its highest level since February. New orders, employment, and shipments all moved back into expansion. But I thought the key point in this report was that pricing pressures intensified here in the near term, but more importantly, expected 6 months ahead prices paid leapt to the highest since January of 22. Inflation was basically out of control in January of 22 before the Fed started to raise rates. So this is a problematic data point, in my opinion. Expected prices received moved up pretty sharply to 59.4, highest in several months. I think the July ISM manufacturing report is likely to rise and probably above the key 50 level that indicates expansion. We had a strong Empire manufacturing report. We've had a strong Philly report. Those two are usually pretty good indicators of the trend in the big ISM that is important for equity investors. So we think this Philly Fed report makes the Fed less likely to cut rates in September, where the market's now pricing about a 50-50 chance of a cut. July, of course, is off the table. There won't be cuts in July. Market's pricing only a 2% probability of that. So that's not going to happen. The Fed, importantly, the Fed is under siege politically. And if higher inflation prints are possibly ahead, things could get very, very tense and interesting. New York Fed President and Vice Chair John Williams said this week that the impact of tariffs are delayed and that inflation is likely headed to 3 to 3.5% by the end of the year. He reiterated that the monetary stance of the Fed today is modestly restrictive and appropriate, and it's hard for us to argue against that. So there it is, your 3 in 10 podcast for Friday, July 18th at 11 a.m. Eastern Time. As always, do the work, endure the pain of gain, and have investment courage.